Welcome to FT Markets. There are two dominant themes at the moment. China, will there be a soft or hard landing? And US interest rates, when will the US Federal Reserve tighten policy? We have Christine Johnson, Head of Fixed Income at Old Mutual Global Investors, in the studio to discuss this. Welcome, Christine. Our first chart shows volatility on the US stock exchanges. As you can see, volatility has risen quite sharply recently and is still at elevated levels. The Federal Reserve indeed made a point of worries about volatility, the global economy, for their reason for holding rates. Was it the right decision, Christine?
I think we've got to remember, first of all, but this big spike, which was almost as big as what happened before Lehman collapsed, this was before the Fed actually moved. So this was kind of a warning shot from the markets. And it reminds us a little bit about who the Fed actually are and, more importantly, what the US currency actually is. The US dollar is the price of money everywhere. If the Fed raises rates, the dollar will appreciate, and that makes the world more expensive everywhere. The sort of feedback loop that you then get for the US economy is there's enough evidence to suggest if you have a meaningful appreciation of your currency, what will happen is your GDP will actually slow. So yes, I think they did the right thing by pausing and not raising rates. I don't think they did a great job in terms of communicating their reasons around it.
Why were they so poor at communicating, as a matter of interest?
I think it's difficult because for them, they've been quite specific, they've been very data dependent, all the data looked okay, to now hesitate and not say very clearly, okay, so now we're taking other things into consideration and therefore give a clear signal of when they are then likely to raise rates. I think that just leaves confusion behind, and that's what you've seen with this market disruption that we've had in the last few days.
Our second chart then is on implied US interest rates, and it shows that the market now expects rates to be held this year and not rise until next year, and when it will gradually go up. The question that seems to be on the lips of a lot of people is what are the dangers of staying too low for too long? Is that a risk that the Fed has?
I think this tells you quite a lot about actually how cause and effect works. The Fed does not want to surprise the market. The Fed wants the markets to do the work for it. So really, by the time this line has moved up and the market is anticipating rate rises, that's when the Fed's going to raise rates. Now, you're absolutely right. Over time, this could be a policy error. You could be facing a runaway economy where you're going to have to do multiple rate hikes, and this line could move quite quickly upwards. But one thing central banks know how to do is control inflation, and they know how to slow an economy. They've done it before, they've got a track record. The one thing central banks have no successful playbook for is how do you get economies out of deflation. So it's better the devil you know, better to be late and solve a problem you know how to solve than go too soon and push the economy possibly back into less growth and even lower inflation from here.
In other words, the Japan scenario is the one the Fed wants to avoid.
That is the spectre. That is the thing that everybody is desperate to avoid, of making that policy error and seeing, that lost decade or even lost 20 years, which you can now say that Japan has suffered.
Another big uncertainty is over Chinese data.
Yes.
Is China growing at 7%? Is China growing at 3%? There are divided views there. So China still clearly is the big issue amongst lots of other factors out there. Would you agree with that or not?
Oh, absolutely. And I think the thing that's really started to spook people is the movement in commodity prices. That movement is so large, and the way that it started to fall last year, then it plateaued, then there was another big fall in the summer. That should be usually a leading indicator. And if that's correct, that's telling you that possibly China is slowing much more quickly than they're actually talking about, and that has consequences across emerging markets and ultimately for developed markets as well.
Thank you very much, Christine. In conclusion then, US rates, China, certainly the two big factors out there, suggesting that 2016 will be an uncertain time for investors and the outlook for the global economy.